Hello everybody, my name is David Caduto and I'm the President and CEO of Terrarrg Insurance Company. I'm here today to speak with you about AM Best ratings and specifically address whether or not the size of an insurance company matters when evaluating the creditworthiness and the long-term viability of an insurance company. Risk managers in the private and public sector try to analyze the creditworthiness of the companies that insure the design professionals that they hire. And one of the tools that they utilize is the AM Best rating system. Now these risk managers have a very important function because they're trying to figure out today whether the insurance company that backs the consultant that they're hiring is going to be there in the long term when claims arise. Because in the design profession, it takes many years for claims to manifest and develop. So it's a very important function that these risk managers are trying to do. They want to make certain that the insurance company is there when they need them most, meaning when claims occur. And the tool that they use is the AM Best rating system. Now AM Best is the leading analyst of insurance companies worldwide. In the United States alone, it analyzes over 3,000 insurance companies, and it assigns various ratings to insurance companies. It assigns a qualitative rating, a quantitative rating, and then evaluates risk-based capital. Risk-based capital is the capital relative to that insurance company and whether or not that capital is sufficient to meet the ongoing obligations of that insurance company. When AM Best reviews an insurance company qualitatively, they assign a letter grade to that analysis. It's very similar to what you see what students will get in school. They'll be assigned either an A, a B, a C+, a C minus, etc., A+. The higher the grade, obviously, the greater the creditworthiness of that insurance company. They will also evaluate quantitatively an insurance company by looking at its size. So a company that is assigned a Roman numeral 5 has surplus of about 25 million. A company that is assigned a Roman numeral 15 has surplus of over $2 billion. But the third and more important evaluation that AM Best does is via their BCAR analysis, Best Capital Adequacy Ratio analysis. In this analysis, a score is assigned to every insurance company in the country. And that score is an indicator of whether or not that insurance company's capital is adequate to meet its ongoing and future obligations. Effectively, it's the creditworthiness of an insurance company that BCAR is talking to. Now, when one looks at insurance company failures over the last 15 years, and we've studied dozens of these, two companies come to mind that specialized in writing professional liability insurance for design professionals. The first is Reliance. 2 years prior to Reliance's collapse, it had a qualitative rating of A- excellent, and it had a quantitative rating of 14, meaning its surplus was somewhere between 1.5 and $2 billion. But at the same time, it had a BCAR score that was hovering in the high 80s, in the high 70s. It failed 2 years later. Now DPIC is the second example, my old company, a company that was started in the early 1970s to provide professional liability insurance to design professionals. DPIC, roughly 6 years prior to its failure, had an A+, that's a superior rating assigned by AM Best. It had a size 10 rating, meaning it had surplus up to 750 million. 4 years prior to its collapse, it had an A rating and a size 14 designation, Roman numeral 14, meaning it had somewhere between 1.5 and $2 billion in surplus. Now DPIC's BCAR score never exceeded 119. In the years immediately prior to its failure, it had BCAR scores that ranged anywhere from a low 100 all the way down to the mid 80s, and then it failed. Now you look at a company like Terrarrg Insurance Company that has a BCAR score of 596. That BCAR score exceeds its nearest competitor by several hundred points. When I look at our competitors and I look at their BCAR scores, I see our competitors have BCAR scores anywhere from roughly 150 to just slightly over 300. And again, Terrarrg's BCAR score is 596. Now, Terra not only has a high BCAR score, it's been in business longer, writing this line of business longer than any except one carrier in the market today, except one carrier. So it's the second oldest professional liability carrier. In the last 25 years, it has produced 100 consecutive quarters of growth in its book value and growth in its and earnings. And frankly, its stock performance has exceeded that of the Dow, the NASDAQ, and the S&P 500, and various other stock indices. So when one is trying to determine the long-term viability and creditworthiness of an insurance company, one should be looking at BCAR, not the size of the firm, because BCAR is getting you the answer that you need. In the case of DPIC and Reliance and several other insurance companies that failed, AM Best, through its analysis, was telling us that these companies were in deep trouble because their BCAR score was less than 100. When a company fails, its BCAR drops to 0. The highest BCAR score you can get is 999, but it's usually assigned to companies that are brand new, have a massive amount of capital, and don't have any claims. And that erodes as risk is offset against capital, meaning claims coming in. So if you really want to find out whether or not the insurance company that you're evaluating, who represents the design professional that you're hiring, don't look at the size of the company, look at its BCAR score. Look at the consistency of its BCAR score. Terra's BCAR score in 2001 was 455. Today it's almost at 600. And we anticipate Terra's BCAR score to grow even further. I want to thank you very much for your time. If you have any questions at all about this presentation, contact me directly or look us up on the web. Thank you very much for your time.